What's up, everybody? This is Sunko, the Korean bro. Today is 2023, February 6th, right? Hmm. And let's read article, right? Let's read a stock article. Hmm. Okay, was I wrong? This hot stock has already doubled in 2023. Let's look at the list of articles, okay? Three top tech stocks to buy during a recession. Does Airbnb have a brand problem? Okay. Three stocks to avoid this week. One growth stock down 14% to buy right now. Hmm. And this recession indicator has been floor proof for 70 years. Here's what it says happened next. Okay. Warren Buffett more than doubles his money on this stock every 2 years. Okay. Warren Buffett's advice for investing in new bull market. Three no-brainer stocks I'd buy right now without hesitation. Three stocks I will never sell. The best stocks to buy with $1,000 right now. Three ultra high yield dividend stocks that are no brainer buys in February. The smartest stocks to buy with $20 right now and hold forever. Uh, okay, let's see. Pal Interactive. Okay, that's the one that I invested to. Pal Interactive. Let's see. Let's see about that. Patent went from a stock market down in 2020 to cautionary tale by the end of 2022. The company brought in a new CEO last year who was in the midst of executing an impressive turnaround. There's still work to do, but investors have a renewed optimism for Patent stock, which has already doubled year to date. Let's look at Patent Interactive chart. Okay, Patent Interactive. Patent Interactive. Patent Interactive. Paladin Interactive. Paladin. Hmm. Paladin Interactive. Paladin Interactive. Okay, wait, hold on a second. Paladin. Peloton. 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 Paladin Interactive. Okay. Okay. Paladin Interactive. Let's look. Paladin's making great progress, but it's not out of the woods yet. I was notably bearish on shares of Paladin Interactive throughout 2022. The company's sales had collapsed. It was burning through cash with a rapidly shrinking window to turn things around. Current CEO Barry McCarthy joined Paladin in February 2022 when the company was in crisis. He embarked on a mission to right the ship. Now, 1 year later, Paladin's financial results for the fiscal 2023 second show strong improvement across the board. There's still a substantial amount of work to be done, and the company's survival isn't guaranteed in the long term. Nonetheless, investors have turned positive on Pound stock, which has already doubled in 2022. Could this be the start of a sustained recovery? Strong quarter second result. Pound snapped its quarterly revenue downtrend. Main challenge going forward. Okay, let's see. Subscriptions could help out and solve one of its biggest problems right now, net losses. As company's overall revenue began to drop off in fiscal 2022, it raised to cut costs in order to clean up its bottom line, which was in the read to tune of a $2.8 billion for the year. That's a mammoth loss on revenue of $3.6 billion. So you can understand why many investors are ready to write off Pound's future. There's a mammoth loss in revenue of $3.6 billion. Mammoth loss on revenue. They simply couldn't afford another year like that one. But to the company's credit, its net losses have come in at $743 million through the first half of fiscal 2023, which is a big improvement. But there's work to do. The company just had $871 million in cash left, so the window to transition to profitability is narrowing. Right, subscriptions which carry a gross margin of almost 70%, combined with cost cuts like layoffs and offshore shoring manufacturing, could be the key to getting there. Patents adjust earnings before interest, taxes, depreciation, and amortization, which strips out one of cost and non-cash expenses like stock-based compensation, came in at negative $155 million in the first half of fiscal 2023. That's down from a $500 million EBITDA loss in the prior year period, making substantial progress. There might be further improvement in the current quarter. Mm. According to Pound's guidance, which suggests its EBITDA loss could come in as low as $35 million. This is a path to further upside for Pound stock now that the company has snapped its revenue downtrend. The next step is reaching profitability to show investors it's a viable business without further capital injections. At that point, Pound and its new management team will have proven me entirely wrong. I might even recommend buying the stock, but for the time being, it's likely safer to observe from the sidelines. So instead of buying it right now, uh, it's much safer to observe from the sidelines because they got a lot of things to work on. And let's go to YouTube and see how people analyze this style, okay? Pound Interactive. Pound Interactive, okay? Hmm. Okay, I think it seems it's gonna take some while because it's a bit long, 10 minutes, and it's not really directly talking. It doesn't really directly talks about um the future of Paladin stock. It mainly talks about earning release following quarter second. So uh, we'll just skip and analyze this later on. Okay. Hmm. Wait, hold on. Let's read a little bit more. Okay, I'm a bit curious. Okay, Paladin's rise seemed unstoppable at the start of the pandemic. Consumers loved its at-home exercise pattern equipment and virtual fitness classes as COVID-19 restrictions appended everyday routines. As a result, the company's revenue soared in fiscal 2020 and 2021, extending its streak of triple-digit top-line growth. But the following year, life for many people returned to normal, and sales for the company saw a stark reversal, with an 11% decline for fiscal 2022. The company had also laid out ambitious expansion plans and was spending money under the assumption it would continue growing at a healthy pace, which led to substantial financial losses. As a new CEO, Barry McCarthy, Java was rapidly cut cost and find new ways to reignite sales. He shrank Pound's workforce from 9,000 to 4,000, closed its in-house manufacturing operation in favor of offshoring. Hmm. And tapped new sales partners, including e-commerce giant Amazon and Dick's Sporting Goods. Okay, I see. So new CEO started working, and he laid off some workforce, and he shrank Pound's workforce from 9,000 to 4,000, and he closed its in-house manufacturing and in favor of offshoring, and tap new sales partners like Amazon, um, Dick's Sporting Goods, and so on. Okay, those are just a few of management's new initiatives, and now investors are beginning to see the results. What follows are some of the most important details from Palan's second quarter report and what the company needs to do to build on its progress. Hmm. The story behind the strong quarter second results. So we have the strong quarter second results, and there's a strong behind it. There's a story behind it, which is laying off some workforce, laying off some people, and focusing on offshoring and having new partnership. Uh, Such as Amazon and the exporting goods, and they're about to see good results soon, right? Okay, so Paladin snapped its quarterly revenue downtrend. Paladin is coming off three consecutive quarters of slumping revenue. It reversed that trend in the second quarter, but from what I see, the main reason their net loss went down is because uh of the fact that people are getting back to their normal life, uh and that their wrong investment, but still they have uh potential, uh right. So let's see about that. Here it is. Pound snapped its quarterly revenue downtrend. It's coming off three consecutive quarters of slumping revenue. It reversed that trend in second quarter, which was helped by the holiday shopping season. Hmm. However, its results of 792 million blew away the company's own guidance of 725 million. Revenue was still down 30% year over year. This has become the new normal as Pound adjusts to the current market, one that has largely moved on past the pandemic and had features significantly more competition. But this latest report could signal a bottom, and investors might soon find out at what level the company's revenue will stabilize. Okay, past subscription revenue top equipment sales last quarter. Okay, patent subscription revenue. So their main profit comes from subscription service, and mm, and their revenue topped equipment sales last quarter. Okay, which has become an important trend over the last few quarters. That's good news for a few reasons. First, subscription revenue is more predictable due to its recurring nature, and it also offers a higher gross profit margin. So, there's a lot of advantage. There are a lot of advantages in subscription service. You can expect what your uh you can expect how much you will earn, right? And due to its recurring nature, and it also offers a high gross profit margin, right? Plus, the Palace subscriptions are cheap and related to the price of its equipment, which typically runs in the thousands of dollars. So the addressable market for them is inherently larger. Mm. So its price is cheap, so inherently, the addressable market is large. Okay, connected fitness subscribers top 3 million, up 10% year over year. That growth rate slowed from a 19% in the previous quarter, but it's promising that customers slow signing up in this difficult economic climate. Mm. But they still have main challenges going forward, right? Mm. Okay. Mm. Mm. We will see about that. There's a story behind strong quarter second results, but then okay, let's skip and we'll come back to it later. Okay. Top tech stocks to buy during recession. More companies will streamline their businesses with ServiceNow as the workflow tools to cope with macro headwinds. Broadcom is better diversified than many other chip makers. Yeah, that's what I covered last time. Broadcom, they cover a lot of things, right? ASML will remain one of the world's most important tech companies. ServiceNow, okay. ServiceNow's okay. Cloud-based tool help companies streamline their work patterns into digital workflows. ServiceNow. That digitalization process makes it easier for companies to expand, reduce their costs, and support remote workers. It's naturally insulated from recession since economic downturns usually highlight the growing need for its digital transformation services. Wow, it's interesting. Economic downturns usually highlight the growing need for its digital transformation services. Okay, that's something that I never knew. Okay. Hmm. ServiceNow's annual revenue grew at a compound annual growth rate of 30% between 2017 and 2022. Expect that momentum to continue with a CAGR of at least 21% from 2022 to 2026. Unlike many other high growth cloud software companies, ServiceNow is firmly profitable on a generally accepted accounting principle basis. ServiceNow stock isn't cheap at 53 times forward earnings, and its near-term growth might be crimped by macro and currency challenges, but its early movers advantage in digital workflow tools. This thickness of its subscription and stable gross margins all suggest it deserves trade at a premium to slower growth cloud plays like Salesforce. So this author says that although it isn't cheap, 53 times forward earnings isn't cheap, but then if you just stick to it, you can earn money at the end because their stickiness of its subscription and their stable gross margins, uh, all will play. And then hmm, at the end, what people need is a digital workflow tools, digital workflow tools, and even especially in this recession, people companies look for digital transformation services. So Broadcom, ASML. Okay. Huh. Airbnb have a brand problem. Companies about Airbnb have gone viral on social media. Gas your fat out with cloning fees and chore lists. Uh, Despite the backlash, Airbnb continues to deliver strong growth. Airbnb cloning fees growth is so strong. Okay, let's see. If Airbnb brand is weakening, there's no evidence of that in its numbers. Revenue jumped to 29% in the third quarter to $2.9 billion. And the company reported $1.2 billion in net income, though the third quarter is its seasonally strongest quarter. Demand soared in 2022 as the travel industry bounced back from the pandemic. Mm. But the company's rapid growth doesn't mean it isn't losing customers through some of the issues discussed above. Airbnb's brand is its most important asset. And the company needs to protect the experience the guests have on its platform. Although it may not sell well with hosts, the company is better off doing things like offering pricing and pushing back on unreasonable checkout tasks, or guests will go elsewhere, and that will eventually sap the business. So here it says, brand itself is really important. Uh, they have to make sure that the guest use it, and then make guests feel they're satisfied with the service. Mm. Historically, Airbnb has been reluctant to set a standard for what guests should expect from a rental. That makes sense as there are so many different kinds of Airbnbs, but most guests want to avoid excessive fees and the hassle of doing checkout tests. Except Airbnb to do more to respond to these complaints to help preserve its popularity. Mm. It's still growing fast, even as there's room for improvement. If Airbnb can solve the most common complaints about it, its competitive advantage will grow even stronger, giving the company more long-term growth opportunity and stock more upside potential. Okay, they still have more room to grow. Mm, I didn't put any money into it. Okay, and we got Nike next. Okay, Nike, whatever. Uh, let's see this. Lesser known sub-index of closely watched economic indicator portends trouble for the US economy. Additionally, the Treasury oil curve suggests tough times may lie ahead for the economy and Wall Street. Despite heightened volatility, weakness in equities may represent a once-in-a-decade buying opportunity for long-term investors. This recession forecasting index hasn't been wrong since the early 1950s. Hmm. Next, Warren Buffett more than doubles his money in this stock every 2 years. The unsung hero of Berkshire Hathaway investment portfolio is dividend stocks. One truly special dividend stock is cranking out a 54.2% year on coast, which is helping Buffett's company more than double its initial investment every 2 years. Let's look at this one. If you're wondering what's made Coca-Cola such a fantastic investment for Warren Buffett and his investing team over the past 35 years, you're not going to settle on a single point. Rather, it's been a confluence of macro and company-specific factors. For example, the vast majority of the beverage products Coke sells can be viewed as non-discretionary. In simple terms, no matter how well or poorly the domestic or global economy are performing, consumers are unlikely to change their consumption habits. So the point is, consumers are not going to change their habits no matter what people experience. Okay? Hmm. Since everyone needs to eat and drink, demand for Coca Cola products tend to remain consistent. So the demand for it is consistent, okay, and predictable year in and year out, right? On a more company specific basis, Coca-Cola's geographic diversity, marketing, and margin levels are helping to steadily move its profit needle higher. With the exception of North Korea, Cuba, and Russia, Coca-Cola has ongoing operations in every other country around the world. This allows you to take advantage of higher organic growth rates in developing and emerging markets, where it currently holds 6% of all commercial beverage volumes. Okay, let's repeat this one more time. This allows you to take advantage of higher organic growth rates in developing and emerging markets, where it currently holds 6% of all commercial beverage volume. In order to generate highly predictable operating cash flow in developed markets, where it accounts for 14% of all commercial beverage volume. So they still have more room to grow since they only have 6% of all commercial beverage volume in emerging markets and developing countries. We have 14% of all commercial beverage volume in the developed countries, so which means we still have room to grow. In terms of marketing coach, nothing short of a superstar, aside from being arguably the most recognized consumer staples brand in the world, the company's marketing department is able to easily connect with multiple age groups. Whereas younger consumers are lured by Coca Cola's social media campaigns and easily identifiable brand ambassadors, more mature audiences are liable to connect the Coca Cola brand with its ties to the holidays. Very few companies have the ability to engage and connect with consumers quite like Coca Cola. Lastly, there's Coca-Cola's ability to use its scale and marketing push to its advantage, refining its supply chains, which includes sourcing products locally, reducing its selling, general, and administrative expenses as a percentage of total sales. So, okay. Mm, blah blah blah. Anyway, the reason Warren Buffett doubles his money on Coca-Cola every 2 years is because it's stable and it's predictable, and no matter what people face, no matter what people are going through, even during recession, customer habits will hardly ever change. That's why he doubles his money on the stock every 2 years. Okay, some might think that Warren Buffett would advise investors to be fearful in a new bull market, but there's more to the story. Buffett recommends sticking to the basics by focusing on stocks valuations and long-term earnings prospects. Any market environment. Legendary investor doesn't worry about what stage the market cycle is in. Hopefully, up close to 16% above its previous low on October 12, 2022, to reach the commonly accepted threshold for a new bull market. Be fearful. Some might think that Buffett would urge investors to be very cautious in the new bull market. After all, he famously stated in 2008 New York Times opinion article, a simple rule dictates my buy. Be fearful when others are greedy, and be greedy when others are fearful. However, most people completely ignore what Buffett wrote in the same paragraph. But fears regarding the long-term prosperity of the nation's many sound companies make no sense. The greed that Buffett referred to is most evident closer to the end of bull market than at the beginning, although the great investor likes the opportunities would almost certainly tell you to ignore what the stock market is doing in 2023. In his 2013 letter to Berkshire Hathaway shareholders, he warned against making investment decisions based on the chatter about markets, the economy, interest rates, price behavior, stocks. So, what's Buffett advice be in a new bull market? Stick to the basics. He wrote to Berkshire shareholders in 2010. In the end, what counts investing is what you pay for business. Truly purchase of a small piece of it in the stock market and what the business earns in the succeeding decade or two. In the end, what counts in investing is what you pay for business. Truly purchase of a small piece of it in the stock market and what the business earns in the succeeding decade or two. There are two important lessons for investors in that statement. First, focus on the valuations of the stocks you buy. Attractive valuations hinge on two things: the price you pay for a stock and its projected earnings. You might be tempted as a new bull market takes off to invest in stocks of companies for which you don't understand the underlying business. Phenomenon. Buffett wrote in 2010 that he and his longtime business partner Charlie Munger avoid businesses whose futures we can't evaluate. Uh, No matter how exciting their products may be, avoid businesses whose futures we can't evaluate. Mm. No matter how exciting their products may be. Avoid businesses whose futures we can't evaluate. Mm. The second key lesson from Buffett's statement is to focus on the long term. Note that he said to look at what a business can earn over the next one or two decades. That's not easy to do, however. If you at least try to make a reasonable valuations of earnings, it should improve your chances of success. Mm. So, what I have to keep in mind are two things. Avoid businesses uh, whose futures I can't evaluate. Okay? No matter how exciting their products may be. Um, Avoid businesses whose futures I can't evaluate. Avoid businesses whose futures I can't evaluate. So can I evaluate the companies that invested? Can I evaluate? Mm, that's really complicated. Anyway, the second lesson that I learned is that focus on long term. He says to look at what a business can earn over the next 1 to 2 decades. 1 to 2 decades. 1 to 2 decades. Okay. 1 to 2 decades. That's not easy to do. However, if you at least try to make a reasonable valuations of earnings, you improve your chances of success. So think what they can do 10 years or 20 years later. Okay. See it long term. 10 years or 20 years later, what do you think they can do? And um, can you evaluate their business? Hmm. You might have noticed that Buffett's investment advice doesn't just apply to new bull market. It just says it relevant later in bull markets or in bear markets. That's not surprising. So even like his advice is it isn't just about it's just as relevant later in bull markets or in bear markets. Buffett would be the first to tell you that he can't predict what the stock market will do over the short term. In the 2008 New York Times article wrote, I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. But if you follow his advice, you don't have to be concerned about bull or bear markets. With Buffett's approach, happy days should be on the way eventually, regardless of what the overall stock market does. Hmm. So it's not you can never get to know what's gonna happen a year or a few months later. What you have to focus on is their business itself. Uh, so whether we'll have a bear market or bull market this year, is not the issue. What's important is will they be able to make something that people use 10 years or 20 years later, or like can you evaluate their business? you know do you really understand their business? Do you really understand their business so that you can evaluate? Well, it's they matter. Okay. Hmm. Anyway, that's it with Warren Buffett's advice. Roku, Fever, and Coinbase have many things in common, starting with enormous and long-lived growth opportunities. Market makers are disregarding that upside today, driving stock prices down through the basement floor instead. You should know the companies like your own back pocket, giving you the option to pounce on fantastic buying windows. A new way of working. The future of entertainment depends on Roku. Okay. Let's read the Fever. I've covered the Roku many times. Let's look at about Fever, okay? As leading service provider in the gig economy, Fever is changing how business get the work done and how people think about careers. How businesses get their work done, and how people think about careers. The market is growing like gangbusters. According to a recent study by Fever rival Upwork, 60 million Americans got paid for freelance services last year, up from 53 million in 2021. So more freelancers are working these days, right? And 50 million in 2020. Mm. So more and more freelancers are working remotely and in online world. There's also plenty of room for continued hyper growth as freelance gigs accounted for just 5.8% of the American economy in 2022. So it only accounts for just 5.8%. Hmm. And most freelance jobs are still managed through pen and paper. Handshake agreements, phone calls, and other old school methods. The opportunity to take this process online is enormous. Fever set at $1.1 billion for freelance gigs in the third quarter of 2022, accounting 30% of the value as revenue through service fees. This sounds like a lot, but the run rate of $4.4 billion works shot to just 0.3% of the 1.5 trillion in American freelance revenues annually. Not Coinbase. Action Disney, iPhone, seriously. Okay, action. United Health, Block, strong growth prospect, and attractive valuation. HubSpot. Hmm. Okay, let's read this one more time. Okay, Square and Cash App. I read it last time, but just to be clear, right? Square is a mobile payment platform that's popular among small businesses. It includes hardware for payment processing, along with software for payroll, transfers, and analytics. Cash App is a consumer financial platform, finance platform that provides services such as transfers, payments, and an investment brokerage. Okay, so Square, mobile payment platform, and Cash App is a consumer finance platform. Okay, Block also expanded operations by acquiring Afterpay. Okay, expanded operation Afterpay, a large buy now pay later service. Buy now, pay later service. Okay. Along with this transformative tech business, Block is also committed to continued innovation. The company has invested internal resources in blockchain, um, other decentralized financial technologies. According to management, the company's significant Bitcoin holdings in 2021 corporate name change are a testament to this. If Block can execute on CEO Jack Dorsey's vision, the company will remain a leader in the rapidly evolving technology world. Okay, recent results indicate Block is executing well. Its gross profit expanded nearly 40% year over year in the third quarter of 2022, with major contributions from both Square and Cash App. Block is also free cash flow positive over the past year. Those are all bullish signals for growth investors, and the company has identified international markets as a major opportunity moving forward. Despite that operational strength, the stock is down nearly 70% from its all-time high. Block tumbled after reaching a sky-high valuation during the market's most bullish months in 2021. It has followed a pattern that's common among growth stocks and any company associated with cryptocurrencies. Block's forward P/E ratio is now just below 50, less than one third of its peak valuation in 2021. Long-term investors who aren't worried about short-term volatility have a chance to buy one of its fintech's best innovators at a discounted price right now. Hmm. Okay, more on automotive stock. Um, C3 point AI. Hmm. Hmm. For the last, let's read this. AI announced launch of its generative AI product shoot on March 2023, launching its stock to 9-month highs. AI generative AI suite incorporates advanced models into its product, including ChatGPT and GPT-3. The company is switching to a consumption-based pricing model, which helps to onboard new enterprise customers during harsh economic climate, keep existing customers who may be downsizing. Every day has assured in time and more headlines covering AI at the platform. Around for over a decade, like International Business Machines Corp, a platform Watson, which launched in 2011. Anyway, it mainly talks about the reason why AI is a game changer. Mm. And C3.ai is the platform that make it possible. It's getting a bit complicated. It's already 12 o'clock, so I'm just gonna wrap it up today. And I'll see you guys tomorrow, okay? Bye bye and have a good night.